A weak global sentiment following the US Fed Reserve's rate hikes roiled global markets this week and led to a sell-off on Dalal Street as well. The Sensex and the Nifty lost 2% on Friday and turned negative for 2022. Hello and welcome to the Editors Roundtable. We take stock of the week's market action and of course put the spotlight on several sectors. This week it's on cement and IT. I'm Sonia and with me today there's a full house, all the editors in the room. Welcome back folks. It was indeed a week where topsy-turvy, but by the end of the week you'll have to say that all markets were down, including us.
Yeah, down but green, Sonia.
Sonia is in green.
Always, right?
That's a support. So that's much needed now.
Yeah, but you know, this week was very interesting because I think the market got a bit tired of hearing this decoupling. So the market said, let me show you recoupling. And I think that's what happened on Friday. And I think the brutal nature in which the market fell, I don't know if it was just cleaning out the excesses. Yesterday I felt the market was cleaning out the excesses. And yesterday was expiry as well. Today, being the first day of weekly series, I know the expiry happens on Thursday. The way the market collapsed, led by the banks, led by the large stocks, my fear is that, you know, the ETF money which drove the market higher, is it on its way out? I think because that money doesn't care whether you're India or China, it only wants momentum, and the momentum clearly is missing. That's my sense, you know.
Absolutely. I think also it's it was just a matter of time, right, before our market sort of gave way, considering that so many rate hikes across the world, and there's an RBI policy next week as well.
The point is, the world is slowing, right? Rates are going up, world is slowing, dollar is going up. Thankfully for India so far, I mean, oil is well behaved. Yeah. So, and I think oil staying at 90 is imperative. So, as Anuj said, it's possible that decoupling becomes recoupling, and I'll talk more about that a little later. Let's hope it's not too big a gash.
Remember, Adam said last week, right? There is nothing called decoupling. Maybe we'll couple less, it will be less coupling, but there is nothing called decoupling in this world. So I guess finally now India is catching up to the global weakness, to the fact that for so long we've been ignoring the global data, right? Dollar index at 111, yields over 3.5, and we're just ignoring all the data and rallying every week. I think that's what the bit of reversal has happened. And also what Anuj said, you know, I guess the feedback what I'm getting is the most crowded trade of late was financials,
Thanks.
and that's what it's playing up on the downside as well. Look at the kind of fall we saw today. Bank Nifty was down 3%. So I guess that's also playing up in terms of the underperformance in financials.
And I think that thesis about the Nifty bank, that's going to be put to test, right? Because that became an overcrowded trade, and if you're going to get a couple of % cut even from here, if it's still good for more, then let's see whether or not you see money flowing back to that sector, because that's clearly been the big driver.
Okay, so are the bears saying abhi to party shuru hui hai? Is that what the angle that we're taking on the show today?
No, I think the market is still fine, Sonia. Okay. You know, look, I'll still give it benefit of doubt because the larger trend is still on the upside. Unless, you know, you start to capitulate completely below 17,000 and all, I think let's give the market. It's been a week, and you know, after all this, how much will be down for the week?
Absolutely.
Not by a lot.
Yeah.
It's okay.
Okay, the sector to focus on this week clearly was IT, right? After Accenture's numbers. So you're going to tell us a little bit about that.
Yes, and you know what? I'll just go through the wall and explain it in numbers because IT was market's first love, and it's almost all of a sudden become its ex-girlfriend, right? Just look at some of the numbers. First of all, in terms of the flows, and this is something which I had pointed out 2 weeks back as well, that financial services are leading the inflow, $670 million, and FMCG, autos, capital goods. So that theory is intact, that a lot of money is shifting from IT. Look at the outflow in IT. This is for the fortnight between September 1 to 15. IT saw outflow of $500 million, and $500 million going out, financial services gaining most of that, and FMCG, autos, and capital goods. But that is now well documented that this is happening. Now let's look at what's happening in the IT sector alone. It's seen negative flows in 11 out of last 12 months. That's the IT index, and it's down about 32% from its 52-week highs. But even after a 32% fall, it's up 46% over the last 2 years. Just to explain this first point more, let's have that graphic. There it is. Just look at this. Just one green bar. The rest is all red bar. This is all the FII data. This is NSDL data that we get, official data. So before that, you had seen this big buying. Now this is all red for IT index and IT stocks. Now let's go through some individual stocks just to highlight what exactly happened in some of these stocks. Let's start with the large caps. Infosys, after COVID, saw 230% rally. It's a large cap stock, giant cap stock. It's fallen 30%. TCS saw 140% rally. Of course, there was a big gap between Infosys and TCS, so TCS has fallen a bit less. Look at Wipro. That is where you had the multi-year breakout, remember? 300% rally in Wipro. It's become half of that now. Even then it's up, right, over 2 years. HCL Tech, 250% rally, it's fallen about 35%. Tech Mahindra had a 240% rally, and it's fallen 43%. I take Mindtree for mid-caps because that really was the sentiment barometer for the mid-cap market. 600% rally post-COVID, and you have seen the decline. Now, what were the key sectors which led to this rally? And I'll come to why the decline has happened. This was the only sector which had earnings visibility after COVID. Zero interest rate was the other factor which was driving valuation. So what happens is when interest rates come down, you tend to inflate companies which have higher earnings, and you keep giving higher multiples. 20% EPS growth, if only multiple goes up by 10 notches, drives stock price by 80%. Yes, that's what happened with some of these IT companies. And of course, the companies then started paying top dollar for the talent because, you know, there was quite a bit of demand and they wanted to pay as much as they could just to get talent. Now what happens? The US Fed starts to hike rates, and that's when the valuation factor comes in. The US companies started fearing recession, so obviously they start cutting down on their expenses. That means there's a margin pinch. And you saw what, you know, the companies losing tolerance, for example, Wipro coming down hard on moonlighting. And now there's fear that this quarter there would be top-line pressure as well. FedEx, for example, is going to cut down on its costs, right? So that is the big problem for the IT companies. Now, just look at the valuations. And this is the point I was making about 3 months back as well, that where do stocks need to go back to before the rally starts again. Infosys pre-COVID, the price earnings was 18. It went up to 32. It's at 25 now. Now, I'm not saying it goes to 18, but it needs to correct to say around 20 or thereabout. TCS from 23 went up to 35. It's at 27. I think it needs to correct a bit more. Wipro has already corrected almost to pre-COVID levels. And I think HCL Tech is the other one where you've seen a valuation correction, compression. Tech Mahindra is the other one. Mindtree from 20 went up to 52. 52 times for a mid-cap IT company. And it's now down to 28. So I think these are a few companies where, perhaps you've seen maybe some value. One final chart, I'll leave it with, just look at this PE versus the stock price for Infosys. This is where when the gap became too big and you've seen the big correction. Remember this. This is when the valuation gap was this big. And when you get something like this, stocks rally big. But when you reach this kind of a stage, stocks fall big. That's the valuation metrics as far as Infosys is concerned, because that really is the barometer of the entire sector. So I think that's something which stood out for me. But Nimesh, what's the dealing room gupshup?
Anuj, I just want to put this week's fall into perspective. Look, we've rallied 3,000 points from the lows of 15,000, right? We were at 18,000, 18,100 something. What we are right now is around 17,300, 17,400. So hardly 700 points or 800 points fall. It's largely a catch-up on the global underperformance. We've been rallied so hard and we've been outperforming every week on week. I guess this is a week where we are doing a bit of catch-up with the global peers as well. The global data has turned a bit more negative. Even the fact that the India macro has turned a bit negative as well. So I guess that's what the bank Nifty fall today seemed to be. I guess that's the simple reason that we are doing a bit of catch-up in terms of the outperformance that we've been doing of late. The other important thing, I met a lot of corporates as well as the investors at the Moti conference. Look at financials, what happened. People are only talking about bank Nifty today, but Thermax in today's trade was down 7%. We saw what happened to Schaeffler this week. We've seen so many of these capital goods falling. So that's basically a reversal of over-positioning or over-credit trade, so to speak, in some of the sectors which got reversed in this week. In terms of flows, again, the feedback is, yes, you may be right, Anuj, to some extent that there is a bit of ETF withdrawal, which is moving from India back to other countries. But I haven't heard any big panic selling, so to speak, from the larger institutions, whether it's FIs or the DIs. And lastly, which has been a consistent feedback for the last many weeks now, the supply of paper. Every week, you're getting at least 3 to 4 blocks where private equity investors, your promoters are selling out. So that's a bit of a warning sign, according to me, and that's going to be the case this week as well. We heard PI Industries selling a small block. So that's something which is going to be irritant in terms of flows. But I guess what happened this week is purely a reversal of massive India's outperformance to the global peers. And that's played out this week.
Okay.
Well, I guess, Nigel, you are going to talk about cement. I'd love to listen to what your take is on cement.
Nimesh, you make a lot of calls and you get most of the market gupshup. For the last weekend or so, people have been calling me up and telling me this deal is going to be announced, that deal is going to be announced in the cement space, and we have discussed this as well off the record. So let's run you through what exactly excited the cement space in this particular, past week or so. Well, what happened first? The new promoter of ACC Ambuja Cements, that's the Adani Group, they have announced they're going to be pumping in big money in Ambuja Cements. And because of that, in fact, the street got very, very excited. Remember, because of that big infusion, the promoter holding was likely to go from around 63% to around 70% post the conversion of warrants. The total quantum was nearly around 20,000 crores or thereabouts. The problem was, sometime during the week, they announced that they have pledged most of this holding, which soured sentiment a little bit. Now, Gautam Adani, he says that they are going to be the most efficient and the largest cement company here in India. That means they're going to be giving Ultratech Cement a run for their money. As per the current plan, ACC and Ambuja put together will be 80 million tons. So effectively, he's saying that they're going to be doubling their capacity out there. The street interpretation is clear. They believe there's going to be big inorganic growth out there. And with this 20,000 crores wash share that they do have, if they do acquisitions at either around $80 per ton, $100 or $120 per ton, well, that'll fit in perfectly. So either around 20 to around 30 million tons is what the street believes that they're going to be looking to acquire. Kotak has come out with an interesting note, and they believe that some of these regional players, they offer strategic value, and that's why they could be part of this big consolidation theme. So let's run you through some of those stocks out there. From the south, we know India Cement. They have dominance out there. In fact, they have 84% of their capacity out there. Large asset, street believes maybe something could brew in the southern part of the country. And in fact, those are some of those companies up there with their capacities. Next up, Novoko. That's been the hot topic out there. Big capacity, 25 million tons or so. Is it on the block? Well, we don't know, but the street believes that there is something going on out there. East Focus Company. Well, moving to the central part of the country, remember, ACC and Ambuja, they couldn't ramp up over the last few years. Another company has been Heidelberg Cement. So that one as well was buzzing in trade, and a couple of other names like Sankey as well as JK Lakshmi Cement. Finally, why inorganic growth? Well, replacement cost. That's the cost of setting up an asset is around $100, $110 per ton. Some of these companies, they are available at much less. So let's see whether or not any of these do get closed out, but the street believes there's going to be some inorganic growth. Back to you guys.
Okay, thanks a lot for that. So that's the cement space, right? Clearly the hot topic this week. But what do you watch out for next week? That is what we're going to tell you. The RBI policy comes up next week on the 30th of September, and a dipstick survey by CNBC-TV18 indicates that there's a 50 basis points rate hike coming, and the stance of the RBI could be cautious, especially after what the US Fed came out with. In fact, Goldman Sachs just raised the RBI repo rate forecast to 50 basis points rate hike after the US Fed meeting, and they expect a further rate hike of 50 basis points in 2023, which would take the repo rate to 6.75% by April of 2023. Now, remember, the rupee was also the big talking point last week, and the RBI intervened to at about 80.8 to the rupee, but the rupee fell to a record low. It had a lot of other global currencies for company as well. And in that context, a couple of things to remember. We are in a restrictive monetary policy tightening cycle globally, right? So not just the US Fed, which raised rates. There was the Bank of England that hiked rates by 50 basis points. It was the 7th consecutive hike. There was the Swiss Central Bank that hiked rates by 75 basis points and now is out of negative territory. In that context, the US GDP numbers also become important, the ones that come out next week. So lots to talk about. We'll do one thing. We'll take a quick commercial break. On the other side of the break, Pankaj Tibrewal of Kotak Mahindra Asset Management Company will be with us to discuss all of these cues. Don't go anywhere.
Welcome back, guys, to the Editors Roundtable. The question that we are asking today, the question that I'm trying to explore today is, will the macro, the tough macro, the worsening macro global backdrop going to stop or at least give a pause to the India equity juggernaut? The way I'm going to do it is not by presenting a lot of data in terms of growth is slowing, rates are going up, because we all know the facts, but through the lens of flows and flows that come into India and into emerging markets. So, I think this says it all, from decoupling to maybe just recoupling, right? This is basically, even after Friday's fall, the equity returns for Nifty, S&P 500 and the emerging market pack in dollar terms. The Nifty, as of Friday's close, is down 8% year to date. The S&P is down 22%. The MSCI Emerging Market Index is down 25%. So, the base case is, if there has to be a catch-up, they could potentially be meaningful downside. Now let's explore this, as I said, through way of flows. India has shown through and how. This data is from NSDL. This is FPI flows into India, and this is the latest data from EPFR. Just focus on the last row here. Over the last 3 months, while emerging market funds have seen outflows of 14.6 billion US dollars, India has seen inflows of 8.4 billion dollars. This is, of course, including September so far. The numbers will change by the end of the month. Minus 14, minus 15 nearly, and plus 8.5 in India. Why is this important? This is important because we get most of our... And as I just showed you, EM funds are hemorrhaging money. Money is leaving them, but we are getting sort of inflows. Only 6% of the flows come through India-dedicated funds. Let me sort of break this active and sort of the actively managed EM funds and ETF EM funds, which will better explain the point. Look at this. Actively managed EM funds have continued to lose money. This is May, June, July, August, September so far. These funds have lost almost $5.5 billion. ETFs, well, you know, they were getting money. ETF, of course, is a smaller component as compared to active, but ETFs were getting money, if you can move on. But over the last 2 months, which is in August and September so far, this number has also started to become negative. This is as per latest EPFR data once again. Look at this, $5 billion came in May, June, July was positive, but small negative in August and September. The number is starting to grow, but on the negative side. The point is this, right? Now, this is yearly flows, both EM and emerging market active funds and emerging market ETFs. EM active funds have continued to lose money for a number of years. 2021, of course, you know, both strategies got money. ETFs have consistently been gaining share. And the point is that this ETF route must not dry up. I mean, this is the route through which more and more people are allocating money into emerging markets. Now, to put this, all of this into context, right? This is a very interesting graphic, I think. India's weight in MSCI Emerging Market Index, which is one of these benchmarks that ETFs use, was 8% in 2020. Guess what it is right now as of the end of August? It is 14.5%. China's weight, which was 30% in 2020, is now, it went up to 42% in September of 2020. 2 years prior, it was 30%. It went up to 42% in 2020. And over the next 6 quarters, it fell to 30%. Similar case for Brazil. The peak weight was 31. Over the next 6 quarters, it fell to 10. Mexico, peak weight was 30%. It fell to 17. And we're at 14.5%. This, I would say, has no predictive value in terms of, I mean, the market cap goes up substantially. This weight can rise. But it does tell you that the weight has already increased quite a bit over the last 2 years, has doubled, in fact, from 7-8% to 14.5%. And, of course, there's a question mark in terms of what happens from here on. To me, I think the case is pretty simple. It's pretty clear. India, while it continues perhaps outperforming emerging markets, other emerging markets, as compared to the rest of the globe, if the globe itself starts to slow down, will it start to hurt at the margin? That's the bigger point. Let's actually put that to Pankaj Tibrewal of Kotak, who's joining us right now. He's our guest on the show. Pankaj, great to have you with us here. Thank you very much. So let me just ask you that straight up. What do you think? Will the outperformance shrink? Will India catch up lower? Or do you think other markets perhaps will catch up with where India is right now? Your sense?
Hello, Prashant. I think your observation is valid. If you look at from the risk-on rally that started in June, most of the global equity markets are now back to their June lows. However, Nifty is still 15 to 70% higher than those lows. And despite of earnings cut being equal to the global equity markets, we believe that flow had a larger role to play. And when the FIs came in and the data which you showed clearly shows that India was the highlight in terms of entire emerging market. However, incrementally, we believe that the domestic financial conditions, which were benign, have started to tighten now. And the LAF surplus, which we saw for almost 3 years continuously, have turned into deficit. And don't forget that the banking liquidity has a major role to play. And if you plot the graph of banking liquidity versus market cap to GDP, there's a very significant correlation out there. So that's one thing which is turning negative. The second thing is that yield curve has flattened out, and that's not a great sign. And also the earnings yield has come almost negative more than 2% compared to the bond yields. So I think time to be a little careful and cautious. I think if globe kind of slows down, it will have some bearing on the overall Indian equity markets. we can't be so much decoupled that calendar year to date, most of the emerging markets plus your developed markets are down between 20 to 25%, and we are flattish year to date.
Got it. Pankaj, the go-to space has been financials. Do you reckon that's where perhaps there could be some steep correction because of the overcrowded nature?
Anuj, there could be some tactical correction out there because that's a large, 1/3 of the weight of Nifty is there, which is in financials. But I think from a slightly medium-term perspective, I think that space will give you that strong earnings growth because the asset quality is still under control. Credit growth is picking up. There could be some pressure on NIMs as you move ahead into the rate tightening cycle. But I think the overall sector seems to be well positioned from an overall market perspective. So I don't see a very steep correction. I think investors are waiting for some kind of correction in this space to go and increase their positioning.
Hi Pankaj, Nimesh here. The other big theme you've been very bullish on is manufacturing. You've been vocal as well that that's one space which you like, and you've been betting as well. Any sense in terms of if there is a global panic, will that underperform, or do you think earnings are going to be quite strong and resilient for the next few quarters from here for manufacturing sector?
Yeah, Nimesh, I think manufacturing we have been talking about for almost last 8 to 12 months, but more and more evidence is emerging. Let me take 2 minutes on this. We traveled across the country meeting a large number of SMEs, companies in the listed and unlisted space. And the sense we are getting that the entire value chain this time is not complaining. And when Indian entrepreneurs don't complain, that means the business is doing well. And when you dig a little, 3-4 things which are adding to it. I think the corporate debt of corporate India is at its all-time low, and we are the most underlevered corporate in the entire globe right now at 46% corporate debt to GDP. And now corporates are looking back to reinvest the cash flows into their business as the capacity utilizations are rising. Second, don't forget the energy crisis which is going on in Europe. And companies after companies across various sectors are saying that the inquiry levels have moved up substantially over the last few months, whether it be on the specialty chemical, auto anks, light engineering, precision engineering, capital goods. And a large number of those companies are looking to outsource to the Indian guys. And I think if China One was talked about, in my view, Euro 1 Plus could be a bigger theme to play out for the next few years. And I think still it's not there built into the numbers of most of the street and analysts. I think that's one very important theme to work out for.
Sure. Pankaj, that's interesting, Euro 1. We'll take that theme forward as well with different experts. But what are your thoughts on the consumption theme? Because we're heading into the festive season and we've seen massive demand, right? Whether it's in autos, FMCG has come back in a big way, especially in Tier 2 and Tier 3 cities. Within that entire umbrella, what are the sectors that you still like, or the pockets that you still find that there's perhaps both growth and relative valuation comfort?
So I think, Sonia, autos clearly is one spot where we think that the cycle is just starting. In the last 12 months, we sold what we sold 12 years back in the passenger vehicle segment. So please wait for the pent-up demand, which will just shoot up, I think, over the next 6 to 12 months in this space. And the kind of feedback we are getting from most of the OEMs is that chip shortages is coming down and the demand seems to be extremely robust. So I think that's one space where it's looking interesting. And let me give you a very 1.5%. And that's been the kind of last decade we lost in the auto cycle. And I think that cycle is looking much, much better. The second space is on the consumer discretionary, is the entire thing to do with the wedding play, entire thing to do with the paint segment, entire thing to do with the home improvement segment. I think that entire discretionary basket is looking good from a medium-term perspective. Staples, still we are a little careful and cautious, but don't forget that there's a data point which is suggesting us that 12 months before election and 6 months after election, normally staples does extremely well.
Sure.
So we'll keep an eye on staples as a category as well.
Okay, that was a short but power-packed interview. Thanks a lot, Pankaj, for joining in.
Thank you.
To all of our viewers from the entire Editors team, thanks for watching and have a great weekend.